Let's dive into the main content of today's video. Many of you have asked me questions that seek absolute answers, like how to precisely identify key support and resistance levels, or how to be certain about one thing or another. And here's the most comprehensive answer to those questions: I don't know. If I knew for sure, my win rate would probably be 100%. But we have the power to make choices to increase our win rate in situations where we're uncertain or don't know. That's to walk away or choose the safest option. For example, in this case, the market is in a 1-hour uptrend. It's an uptrend because of this, so if we enter a buy order, we'll have a higher win probability than if we enter a sell order. On the other hand, looking at this chart, this is a previous high. Here, price reacted to the previous high, pulled back slightly, and then continued to rise, breaking through the previous high like this, so we can somewhat predict that this uptrend will continue to rise. On the 1-hour chart, price moves like this, so this is the key level on the 1-hour time frame. This is the 15-minute time frame. This is a previous high. Since price has broken through this previous high, it moves like this. Therefore, this is the key level on the 15-minute time frame. Looking at this, you ask me, so where will price retrace to before continuing upward? Honestly, I don't know. If we place a limit order, in this situation, we have two options. First, we think price will retrace to here, so we place a limit order here with a target above. Or we think price will retrace to the key level on the 1-hour chart, so we place a limit order here, also targeting above. So, between these two orders, which one is the correct one? I still don't know. What I do know is that the first order has an advantage. It's more likely to be triggered. But it has a disadvantage. The stop loss in this case is not ideal. It's not good. The second order, on the other hand, has a clean and safe stop loss. Because a stop loss placed below the key level on the 1-hour chart is better than a stop loss below the key level on the 15-minute chart, but it has a disadvantage. If price doesn't retrace to the 1-hour key level and instead retraces to the 15-minute key level and then rises, this order won't be triggered. So, if it were you, which order would you choose? We don't have to choose either of these orders. We can absolutely place an order here, with the advantage of easy triggering and a safe stop loss below, targeting above with a risk to reward ratio of 1:3. But this order has a disadvantage. Its target is too far. So, in this case, I decide not to place a limit order up front. I'll wait for confirmation. Price retraces to the 15-minute key level. But these bullish candles aren't strong enough. So, they don't convince me. If they were just a bit stronger, reaching up here, I might consider entering a trade. But first, it's weak. And second, I'm hesitant about the price zone below. So, in this case, I decide to wait longer. When price moves down like this, then I can confidently predict that price will likely reach the 1-hour key level. At that point, I look here. Price passes through this point. This point, many points here. I think placing an order here would be optimal. Stop loss below. Target above. Price breaks the previous high and continues to rise. It still doesn't hit my order placement point. On another note, price still retraces to the 1-hour key level, right here. It just touched here and rose, but it didn't reach the order placement point I thought was perfect. So, in situations that make us hesitant like this, remember we always have the choice to walk away, or, if FOMO kicks in and we still want to trade, choose the safest option, not the one with the highest potential profit. Okay, that's the first main point of this video. Now, on to the second point. No matter what trading method you follow, it all comes down to looking at the chart and identifying 3 points: entry point, stop loss, and take profit. Among these 3 points, the most important is the stop loss, followed by the take profit, and the least important is the entry point. I'll explain each one. When entering a trade, naturally, your first concern is whether the trade will win or not. Then you think about achieving a high risk to reward ratio. To have a high win rate, you need to trade with the trend on the time frame you're entering, which I often call following the smaller wave. Then, place your stop loss behind the correct key level, ideally behind a significant key level. Just doing that already gives you a high win rate. Next is the take profit, TP. To set a good TP, you need to look at multiple time frames to know where you stand in the main trend or a retracement wave. But for the easiest TP, simply take profit at the nearest key level to you. Now, the least important is the entry point. A good entry point helps you achieve a high risk to reward ratio, but it doesn't determine whether your trade wins or loses. Still, it's a factor that helps you become a consistent winner in the long run. From my personal perspective, to win in the long term, only enter trades if they at least have a risk to reward ratio of 1 to 2. That's the theory. Now let's move to practice. Looking at this chart, the previous trend was an uptrend. This is the key level of that uptrend. Price has broken through this key level, so the uptrend has reversed into a downtrend. Therefore, looking for a selling opportunity would be more advantageous than looking for a buying opportunity. But if there's a good opportunity, I'd still buy in situations like this. This is the 15-minute time frame. It's also in a downtrend. In this case, if we enter a sell order, the stop loss would have to be placed up here, which is too far. We wouldn't have an edge, so we won't sell in this case. If we enter a buy order, thinking we'll follow a retracement wave with a stop loss below and buying upward, there's no solid basis for it, because a trend with higher highs and higher lows hasn't formed. What if it's not a retracement trend, but just a brief pullback before dropping again? Then our order would hit the stop loss. That's why, in situations like this, we wait and do nothing. At this point, I can confidently say, this is a trend with higher highs and higher lows. It's a retracement trend. Of course, for me, I could enter a buy order. In this situation, we can buy in a retracement trend. So, where's our take profit point? Remember, this uptrend is just a retracement trend. So, we need to target the nearest key level to us, because we don't know how far this retracement will go. Be as safe as possible. This is the nearest key level to us, the previous low. This is a good take profit point. Once we have the TP, we determine the stop loss. Where's our stop loss? Our stop loss is behind the key level of the uptrend, and ideally behind a significant key level. This is the key level of the uptrend, and this is a safe stop loss. I've determined the stop loss. I've determined the TP. So where's the entry point? For me, to find a good entry point, it depends on 3 factors. First, patience in waiting. Second, market experience. And third, an indispensable element, luck. If we enter a buy order, in this situation, with stop loss here and TP here, if the risk to reward ratio is too poor, we obviously won't enter the trade, we'll wait. Price has retraced, so where will it retrace to? As I said, it will retrace to one of 2 points, first, this key level, or second, the previous high. As I mentioned, we place a limit order here, stop loss below, target above. But in this case, if we place an order like this, it only has a risk to reward ratio of 1 to 1.2. It doesn't even reach 1 to 2. I won't enter a trade like this, and I'll assume price will drop to this key level. If it doesn't, fine, but if it does, that's great, so I've placed a limit order here. Stop loss at 20 pips. Target above with a risk to reward ratio of 1 to 5. Let's look closely. My entry point passes through these 2 points. These 2 candles and touching this wick make it more likely to trigger. Then placing a limit order below. Placing it here makes it more likely to trigger. Stop loss a bit further, about 20 pips, that's how I place the order. And so, this order hit TP. It hit my entry point and reached TP in just about 45 minutes. That's pretty fast. This is one of my fastest trades. So, before entering a trade, focus on finding a safe stop loss and a good TP first, then find the entry point. Do the important things first, then wait patiently. When you see a good opportunity for an entry point with a higher risk to reward ratio, that's when you enter the trade. And now, a small tip to end the video. I'll talk again about the true purpose of trading. As I mentioned in a previous video, we start trading and investing with a common goal to make more money. But money isn't the ultimate goal of trading. We don't enter this field to make tons of money and buy expensive things, to use as a measure of success, to show off on social media. Showing off depends on each person's personality, so I won't discuss whether it's right or wrong, but because many traders do this, it unconsciously sets a standard that successful traders must live extravagantly. When we look at others' material possessions and achievements, an average person will feel either jealous or FOMO. Ultimately, it boils down to envy or jealousy, which are 2 things you cannot afford to have. If you don't want to blow your account and want to make consistent profits from the market, that's why, as a trader, I stopped using social media. Now, talking about money, most people always feel it's never enough. What's the point of having a lot of money? Many find this question amusing, and some even mock it. But that's the mindset about money, of the rich versus the poor. It's like trading. If you make money, your top priority in this field, you'll always feel the need to get rich. To escape the cycle of working 8 hours a day like now, to become successful, to make $1 million or more. So, you'll always feel rushed. But trading is a profession only for those who are patient. That's why I never teach scalping and emphasize so much in my videos about being patient and waiting. So, if it's not money, what makes trading special compared to other professions? It's freedom. When it comes to freedom, everyone envisions it differently, with their own aspirations. I'll talk about freedom from my simple and pragmatic perspective. First, I no longer have to drink with people I don't like. I don't have to try to please anyone to advance in my career. I can take a day off whenever I want, without worrying about affecting others' work. I don't need to care about current trends or know the latest hot news to connect with others and seem up to date. I can stay at a homestay for a month to escape the peak summer heat, or stay somewhere warm to avoid winter's cold without disrupting my work. And best of all, I can wear shorts, eat what I like, and no one notices me. There's a lot more cool stuff, but I'll stop here. That's the true meaning of trading. I believe these simple things I just mentioned will help you stay calm and patient. When you start understanding how the market moves, persist in correcting mistakes and waiting patiently, and over time, compounding profits will bring you to shore. At that point, you'll achieve what you desire in this field. Goodbye, see you all in the next videos.